Hello, I'm Tim Wynn-Jones. It's good to be here today. Thank you very much for having us. I am the head of new product development and investor relations for Blackfinch Group. So I'll start with a bit of a general overview of Blackfinch and who we are. We're a multi-asset investment manager based in Gloucestershire. We're a team of more than 150 people spread across the UK, and we manage over 900 million of assets now. We raise capital from a combination of retail investors and financial advisors, and we deploy that capital across a range of tax efficient investment products across private markets, as well as providing listed investment portfolios for a number of our advisors. Our solutions span our Adapt IHT service, which invests primarily in real assets across energy, property, and forestry, through to our AIM portfolios, asset management, and a corporate management service. So we are truly multi-asset. And this provides a mixture of capital preservation, growth, and income solutions for our clients. But obviously, of specific relevance today is Blackfinch Ventures. So established in 2019, our ventures team has invested over £120 million into a portfolio of over 40 companies. And that is through our venture capital trust and enterprise investment scheme portfolios. Having both EIS and VCT products is obviously a real benefit because it allows Blackfinch to invest through the early stage life cycle of businesses. And in many cases, we co-invest between the two. Typically, the EIS invests in earlier stage opportunities where we identify technology businesses on the cusp of their scale-up journey. We source all of our investment opportunities ourselves through research and direct outreach. We see well over 1,000 companies a year, and then we typically filter those companies, we meet them, and we also do very in-depth pitches with those companies, typically 3 hours or so, which sounds like a very long time, but it's a very tried and tested process for really understanding what these companies are pitching, and also crucially going beyond the sort of high level, very slick investor presentations as they usually are, to really understand some more granular detail around everything from go to market, the financial model, the technical assumptions, what kind of support they have, etc. So we also co-invest with many other venture capital providers, and we typically look for early stage businesses at seed to Series A, where we invest typically anywhere from £500,000 to £3 million. We focus particularly on technologies solving real needs in deep markets, and particularly with businesses that have long-term recurring revenues and low churn. Really importantly, though, we focus on talented founders and teams who can show that they have the expertise to adapt, evolve, and thrive, which are our company values, because the startup and scale-up journey is always challenging. There is always going to be the need to adapt and pivot the model. And so really, we're focusing as much on the team as we are on the product. There has to be product market fit. There has to be a really clear growth trajectory, and it has to be a deep market. But I can't emphasize enough how much we focus on the founding teams and their experience and their ability to scale. On this slide just shows diversification. This is incredibly important to our advisors and their clients, and our portfolio really reflects this. So this is just our EIS portfolio. It doesn't incorporate our VCT investments, but we carefully spread our investments across sectors, industries, technologies, and stage of company. So it's always a very carefully put together piece. That said, we also look to attract the strongest companies across 3 major growth themes that also align to our group-wide expertise. These are the energy transition. So we leverage the experience of our energy and property teams. Deep tech, we have 3 PhDs on our team, so we have very strong links into universities and incubators, and we spend a lot of time nurturing those relationships, both to source opportunities and also external expertise and advice on both opportunities that we see in our pipeline and also in helping our portfolio companies scale. And fintech, we're quite unusual for an investment manager in that we have our own CTO from the pensions industry, we have our own dev team, and we have our own intra-company startup that we launched focused on pensions called Thrive. So we really do lean into our group expertise in these particular areas. You will recognize there one of the examples that was in Declan's presentation. So we are a co-investor with OnePlanetCapital in GT Wings, which is the wind propulsion technology for commercial shipping, which we fully support as a fantastic business and has really showed great progress with 10 transatlantic crossings now of their first product, and they're already iterating their next product and working with some major global shipping companies. In deep tech, again, another one that Declan referenced, Kelpie, and also Neuranics, which is another great business. And in the fintech space, Currency, which is a fantastic business that is effectively a layer on top of your current account that allows you to spend abroad without incurring all of the foreign exchange transaction fees and banking fees. So it is as if you are paying directly from your UK-based bank account, which saves a lot of money for a lot of people when traveling abroad. Our point of difference really is our team. So we have a combination of investment specialists, exited founders, and key team members with direct operational experience in the sectors in which we invest. We make that a key point of our recruitment. And so these are people that have been there, understand the industries that we invest in, have faced the challenges, warts and all, of growing businesses in that space. So it's very, very important for us. And that's also supported by a venture partner network of industry experts who we typically appoint as advisors or non-executive directors to the boards of the companies that we invest in. So we typically have a board observer from the Blackfinch team, and then also the external industry expert. Again, it's very important to us that we do have that objective, impartial and unbiased advice. But also, again, these are people who have been there, done it, and it's really important that they are in these board meetings and really helping steer these companies and give them the advice and connections that they need to grow. So fees and details are available on our website and in all of our literature. But just to cover this briefly, our minimum investment is £10,000. We target a return of 3x. The investment objective is growth. We have a 3% upfront portfolio establishment fee and then a 2% per annum annual management fee capped at 4 years. Our performance fee only comes into effect when we have achieved 130% hurdle rate. So, and that's a 20% performance fee at that point. We have a target exit period of 4 to 7 years. And then the exit routes, which will be understood by most on the call, are either through a trade sale. So we do see a number of corporates and others looking at strategic M&A or initial public offerings. So going public via IPO. An important one, we do deploy in up to 12 months, but we do have the option for full deployment within the current tax years. That's very important, obviously, to achieve the tax benefits that many of our advisors and their clients are seeking. So we do pride ourselves on that. We are very mobile and nimble. We've really sort of evolved beyond tranche-based investing. We are looking at investments all year round, and we invest into a minimum of 10 companies per investor, unless they wish to have direct exposure to particular underlying opportunities. But the important thing is that even if we receive applications in mid-March, we can guarantee full deployment by the 5th of April to be within tax year. So just to summarize, the reasons that Blackfinch are well placed in this market: firstly, the attractive tax benefits that apply across the EIS space, but also we do build very diverse portfolios with a minimum of 10 companies. And the fact that we can combine with many other investment vehicles such as the VCT or IHT means that we can build investment portfolios based on client needs around whether it's capital preservation, income, or growth. We can invest quickly and accept applications up to mid-March, supporting growth companies with providing tax wrappers and also providing that access to alternative asset classes, and with a particular focus on finding, identifying, curating, growing really high growth opportunities within the UK. So that is it from me. Thank you very much.
Thanks very much. Very informative again. You mentioned there the overlap where you've done a co-investment with OnePlanetCapital, and we know that happens quite a lot in the space. Given a lot of the managers invest in similar companies and sectors, etc., what's the differentiator for people looking at Blackfinch, I guess, versus other managers? And obviously not to put OnePlanetCapital down because you're both working together as well, but what's the key differentiator?
I think the importance is that we're quite flexible and adaptable. So we typically lead rounds and have historically led rounds, but that's not always the case. There are other investments within our portfolio. For example, we are invested in a business called Supercritical, which is a electrolysis manufacturer for the production of green hydrogen, and they particularly focus on the production of ammonia, for example. So this isn't hydrogen for home heating or transport, where we think that's a lot further out. There's a huge existing demand for hydrogen in industrial processes, particularly that manufacture of ammonia that covers cleaning products and everything else where ammonia is an essential component. In that round, we co-invested with Toyota Ventures and Shell Ventures. So we were a much smaller investor in the round. But the fact that we're adaptable enough to work with Toyota Ventures, Shell Ventures, the very large investors, and the likes of One Planet at the smaller scale, who we really value working with, we've got a great network, which means it helps with us sourcing the really good deals. Because firstly, we place a lot of stock on our network and working with the right co-investors. So we take deals to them, they bring deals to us. But also, it is a very competitive landscape. There are a lot of venture capital providers out there. We look to really attract the best companies, and we do that, as I mentioned, through our internal expertise, but also because of the caliber of the co-investors that we work with. So it's, you've got to be able to present to investors that full picture.
And then I guess you mentioned there about the pipeline, the companies coming through. How do you source those companies? What's the key source for you guys?
It's a real mixture, to be honest. A lot of it is the word of mouth now. We've built a very good reputation as a very good manager to work with, and we've added a lot of value to the companies that we work with. So a lot of our portfolio companies do recommend us to others, and founders tend to be quite, they're very well networked with other founders, whether they've come through incubators or things like that. So word of mouth is a big one. We do a lot of research in-house. We have proprietary tools help us to identify companies before they actually go out to raise. So we've trained an AI tool that effectively shows all of the key characteristics of when a company's going to raise. So we contact them via outreach to say, are you in a position to be raising? And quite often they say, oh, that's funny, we've just been talking about it. And that's no coincidence. That helps us get in early with the really good companies. And that's really important to really kind of build a rapport that way. And then also just through networking and events, we have a number of companies approach us, even through our website. So it is multi-channel, but really the largest one is our own proactive outreach, because we don't just want to be looking at any company that approaches us. We want to go out and find the best ones.